Good evening, folks. So today we are recording our weekly wrap, not in the morning, but in the evening. There's been so much happening. We wouldn't have been able to capture all of it in the morning, right? So we had to do it at the end of the trading day. And it's been, this week reminds me of one of those dusty rhymes. Hushya, bushya, all fall down. So I'm seeing everything down. I need to figure out what is up, Dhruthi. Okay. So,
you're right. It's been absolutely crazy the last 1 week. Today included, it's been a bloodbath. All the asset classes are down. I think apart from one or two markets, globally, everything is negative. All your asset classes are negative. And even INR actually hit an all-time low today.
what was up?
So South Korea was down by 6%, but what was up was actually Brazil, which was up by about 3.7%.
The Nikkei was up 3.6 also. Yeah, isn't it? So these two countries are sort of outliers.
That's right. So apart from that, we also have a couple of factors that played out pretty well for us this week. So we have the low volatility index, which was only down about 0.4%, and quality, which was actually positive at 0.3%, versus the Nifty 50, which was down by 1.5%. And such factors usually offer good downside protection and tend to do well during bear markets, and that's a big place to be right now.
So I guess it would have been tough for an investor to time the entry into low vol or quality. It's best to have them always in your portfolio. What do you think?
That's right, and I think that's actually worked out really well for us in the last couple of years. And also having momentum as a factor along with these two, it's played out pretty well for us.
At a time of crisis like this, what better to have in your equity portfolio than high quality companies? So the quality factor, I think, is that we are both to the season at least. And it's playing off 0.3% up when the entire market was actually down. And then some of the rupee has had a bad time. Almost 94.5, 94.8. Yep, touching 95, which like all-time lows. And it's not going to be easy on the macro scenario when you have the rupee depreciating so much, knowing that we import a whole lot, right? And all this is happening in a time when our FPI flows are negative. I mean, it's been so many months that FPIs are continuously pulling out. So every time they sell, they're demanding dollars and selling rupee. So that's an outflow. And FDI, though we have been having FDI, you're also having a lot of repatriations. A lot of large investors, private equity investors who have sold their old investments and repatriating the money. So as a result, net FDI is almost close to zero or maybe slightly negative. All this along with a rapidly rising price of oil is causing a strain, and I think it's likely to cause a strain for some time to come. And this is also causing the 10-year bond yields in India to move up. So we've almost moved up to 6.9% on the 10-year India government. And we've seen it like coming up from 6.2, 6.3 as a recent, by recent I mean like a year back. Whatever the RBI has been doing to soften that, it has not been reacting. One, I guess, has to keep in mind that the US bond yield is also rising rapidly here.
That's it. So it's currently at 4.5, which is up about 1.7% in just a week.
Yeah. So I think before the war, it had touched the low of 3.9. We're up at 4.5. So when you have the US Treasury itself at 4.45 or 0.5 touching, we can't have the spread between the US Treasury and the Indian G-Sec too narrow. Okay. So we are going to face a problem on this. It'll be very interesting to see how these central banks are going to tackle their monetary policies everywhere in the world, not just in India, not just in the US, because globally we are going to face the pain of higher inflation, primarily driven by oil and the derivative. Like you use oil everywhere, either directly for energy, or energy is used to manufacture other goods. So we are going to see a spike in prices unless this comes down, unless they walk ends soon. So we've been having a bad time with this. Another thing is, yeah, there seems to be a pattern. It does look like Trump is following an algorithm. Whenever the U.S. Treasury is closer to 4.5, he does something to soften the blow. Okay, he rolls back something, either when it was during the tariffs or whenever the crisis is taking it to 4.5, he relaxes. He relaxes sanctions, he relaxes tariffs, he relaxes policy on peace or negotiation with Iran. And
That's exactly what's happening right now, right? He's actually extended the ceasefire to 10 days from 5 days.
is into April now. So this seems to be a playbook. Of course, he is so unpredictable. I don't know when he'll change the playbook. But here is a fundamental, right? The US cannot handle a high game. The rate at which they are borrowing, the trillions of dollars that they're borrowing, they cannot afford a higher interest rate. So there's a fundamental reason for keeping it below 4.5. Oil has been all over the chart.
Yeah, I mean, the only thing that's actually been doing well, or didn't done anything, in fact.
So even though oil ended at 110.4, that's only Brent because the US oil rates up at all right. Brent is the one that comes in from the Middle East and it is stuck because of the war. And every time there is a statement made by the US government, you see the oil price fluctuating. So it's and there's just 1 week, it has gone from a low of $97 to a barrel to a higher point, $40.4 a barrel. This is the kind of wild fluctuation that oil has been having, and very, very tough to call it because the situation changes every day.
And I think another interesting thing to note is that if you actually look at the 7-day change, right, it's pretty class, the price of crude oil. And that's again because whatever was facing right now is because of supply chain disruption. There's no shortage of oil as such.
Yes, we have to bear that at mind. There's enough oil in the ground. It's just that it's not reaching the consumer at the moment. And that will come to a close at some point of time. So I think that's about the market. And let's see what's happening to the trend map. ET Wealth always has this interesting trend map. What's this week's trend map?
Right. So this tariff, ET Wealth is telling us to not get swayed by any one single asset class, right? So asset allocation is always the way to go. And we know that different investors have different asset allocation based on their risk appetite. But we can actually see what's been the best performer so far this year. And it's actually been the portfolio with equal allocation to equity, debt, as well as gold.
Okay. That's a 10-year winner, is it? Or no? That's done well. 1, 2, 3, 4, 5, 6 out of the last 10.
Yeah. Which is, quite surprising because you don't really expect people to have 33% allocation to gold in their portfolios.
Isn't it? So the portfolio that has been doing well the maximum number of years in the last 10 years is a very improbable portfolio. Though with hindsight, one can say that having 1/3 in gold did well. How many people do you know, or how many do I know who had 1/3 in gold?
That's it.
I don't know anybody who had 1/3 in gold. And we have not advised anybody to have 1/3 in gold.
Right. And I think, that's right, we haven't. And if you look at the 10-year performance of these 7 different portfolios that ET Wealth has compared, the portfolio with 70% allocation to equity and only a 10% allocation to gold is actually been the best performer over the last 10 years. And the portfolio with no allocation to gold has actually been one of the worst.
So gold obviously did a lot to improve returns, portfolio returns, given the stratospheric heights to which it has gone free. And the one that is probable, you have one allocation with 50% equity, 10% gold, and 20% debt. It seems like a commonly available portfolio, right? It's quite probable that many investors would have had such a portfolio. And on a 10-year period, that did 11.2% CAGR, okay, as compared to the best of
12.4%, which had about 70% to equity, 20% to debt, and 10% to gold. And I think another thing to note is that this year equity is what's been dragging portfolios down, but in the long term, that's actually the driver for growth.
Yes. I think one couldn't have done too bad. It's about a 1% per annum CAGR to pay in most a commonly held portfolio and the best trend of it for in the season. That's a 1% compounded over 10 years, 10%, but that, still reasonably. Is it right? And I think we also have an interesting, the MIP has its headline today on valuations. And the headline says, correction cools street valuation to peer levels. So basically, you've seen the Nifty has had a drawdown of almost 14.5% from its high. Okay. And obviously the price earning multiples have become much more friendly after the fall. We were in overvalued territory, above fair value territory for a fairly long period, because of which we've had this time correction also. And now we actually have had a reasonable fall. Not only in India, most equity markets are connected. But the way the dynamics have worked out, it does look like India is much closer to fair valuation now. The 10-year median trailing the P was about 22 and we are now at 19.4. And after today's crash, I guess we are closer to 90 in terms of price, multiple. And the other markets are all above. Okay. So if you're looking at the S&P 500, that's about 24.6 multiple. The Nikkei Japan is at 23.3. Taiwan is at 22.3. South Korea is lower at 13.7. UK at 12.5 and the Hang Seng at 10.1. So you get an idea where we are. As a large economy with one of the best growth rates and a 19 times 2AP, I think it looks pretty attractive. And I'm hoping the FIIs are reading these numbers and coming back into the doors.
Yeah, and even so far in 2026, we've actually seen FIIs pull out about $1.25 trillion. And, hopefully they start putting money back in India, because these valuations will look very attractive.
These outflows are what putting pressure on the OP. It's quite amazing that in spite of a $1.25 trillion outflow, the markets are paid up. It's domestic investors pitching in and buying stock much more than we could have expected, say 5 years before.
Yeah, that's true.
I think Indian investors are becoming more and more mature. Let's see. If they actually become more mature, you'll see how the crisis is treated by them. We also had an interesting interview with the DSP mutual fund, Sahil Kapoor, who is the head of products at DSP. And the headline says, equity market extremes are creating rare contrarian opportunities. And going by valuations, what Sahil says in this interview is that a number of private banks, IT companies, some FFTG names and housing finance firms were trading at valuations last seen during the global financial crisis. Okay, so many others were at or below their long-term average valuations. Together, this segment makes up roughly 50% of the market. At these levels, investors can build a portfolio with a potential return on equity profile of 15 to 60% or more, while paying valuation multiples of around 17 times or low. So this is an opportunity, going by what Sahil Kapoor says in this interview, and the numbers say it.
Yeah, and earnings are also subdued at about 8 to 10%. So it makes the opportunity even more compelling. So, if you have any liquidity, this is really a great time to pump money to your portfolios.
So with earnings being subdued, we are looking at, a 19 times trailing cash earning. And we are looking at half the large cap companies at decadal low at 17 and below. So even if earnings recover, you are going to see, you're going to realize that these are very attractive prices to buy. At least the sectors that have been pointed out. in this newspaper article back. Guessing. And there's a question. What is your view on small and mid-cap stocks at this point? And Sahil says, valuations, the small and mid-cap space have corrected to some extent. Earlier, only about a quarter of the stocks in this segment offered reasonable valuation comfort. Now that number has risen to around 40%. So obviously, a lot more of the small cap universe is available at reasonable valuations. But he says, mind you, however, that does not mean the space is broadly cheap. Many stocks are still trading above the long-term average valuations. So while the situation has improved, it is not yet a market where you can buy indiscriminately. So one has to be very cautious when you are buying small cap or mid cap stocks, is what he's saying very clearly, and I agree with him. But what about the data that we were speaking about earlier on small cap?
Yeah, so another thing to note that is, it's about the liquidity in the small cap space, right? So AMPI data is showing that mutual funds are now taking much longer to liquidate about 30% of their holdings. So even your largest mutual fund, like the Nippon India Small Cap Fund, right? So which used to take about 44 days to liquidate about 50% of their holdings, is now taking 13 days more. It's increased in the last 1 year. And then we have Quant, which has actually risen very sharply by 31 days to 87 days. And similarly, HDFC and SBI, which is up by 4 days and 9 days respectively.
So I think we should not take this data lightly. There is still a large amount of illiquidity for small and mid cap stocks out there. And what this means is that funds are likely to take more time than they did last year to liquidate a significant part of their portfolio. So this does link a cautious well. So please don't be indiscriminate and be careful when you are buying small and mid cap funds even now.
And another factor which is driving this rise in liquidation timelines is the surge in AUM, right? So higher exposure to the same stocks has actually reduced the liquidity, and it's increasing the time required to sell off these companies.
I think that's why, now when I look at some of the stocks in the small and mid cap PMSs, even though their drawdown is huge and they hold large portions of their portfolio in these stocks, the must be the liquidation. They're not able to sell them. So they have no choice but hold on to these
That's right.
stocks even with the huge drawdowns.
Exactly. And if a redemption pressure actually increases, then funds will actually struggle to find buyers without triggering sharp price corrections.
So I guess diversification is still a mantra which we should not forget.
Yes, of course.
Even given the opportunity, even large caps have fallen significantly, and large caps, as you speak, are everything that good valuations. So even if you are thinking of buying into this fall, okay, with the confidence that it would come back at some point of time, diversification is a good way to do it. Buy large cap, also buy mid cap, also buy small cap, but have your proportions such that you are able to absorb the risk that they represent. And it also makes me think, Sahil Kapoor says that we are at extremes, and extremes always present a good opportunity. But are a lot of clients wanting to take this opportunity, or let's not say clients, are a lot of people wanting to take this opportunity, or are they worried?
I think it also depends on how long these people have been investing for, right? If it's a new investor who's only been in the market for the last few years, they're definitely panicking. And I think most people do want to pull out money from their portfolios and park it in something safer. But more mature investors have seen multiple cycles, and they know that your market always bouncy back.
Yeah. So I guess, it can't be that all crises are the same. Every time you have a crisis, there's a different factor. So you cannot say that, it's the same this time. It's never the same this time. But the impact can be the same. It could be an economic crisis. It could be a war kind of a crisis. It could be a COVID kind of biohazard crisis. But the common impact of all these problems were that markets fell. There was an economic fallout, there was impact on capital markets. But even in the worst of the situations, okay, the markets did bounce back. So the global financial crisis, 2007, 2008, we were seeing banks shut down left, right, and center. Okay, markets were panicking, investors were panicking. Even from such a bad crisis, it took about 1.5 to 2 years for markets to come back to the earlier levels and even give gains. That's right. So what is 2 years when you're coming into equity the 5-year horizon?
Correct. And I think something similar happened even during COVID, right? So, I mean, nobody had seen such a, nobody had ever been in such a situation before. Everybody was panicking. We saw the market correct almost 40 to 45%. But the 12 months after the market bottomed out, we saw returns of about 85%.
Yes.
And this is what happens if you just stay put during, such times.
So yeah, 2 severe crises, and both of them, people thought it was the end of the world. But markets bounced back because governments do either way. Central banks do either way to control a crisis and get things back onto their feet. So let's have confidence in that. And here too, we are in a war in the Middle East. India is not at war. Thankfully, we are fairly comfortable. We are not declaring a national emergency, at least not yet. We are having enough oil, we are having enough LPG to go by. I think the government is doing a wonderful job as far as supplies are concerned. But the point I'm trying to make here is that the countries that are at war, that is Iran, the US and Israel, the 3 countries, okay, it is quite clear that Iran is not as strong as the other countries. They are defiant. They definitely are putting up a fight and a good fight. But will they be able to win over a military power such as the US? Definitely not. Or a high probability that they will not be able to win over the US unless somebody resorts to. I know they don't have a nuclear bomb, so I guess they will put up a fight, and at some point of time they have to pull it fixed. So will this war end? Yes, this war will end. One party will lose. Okay? And oil supply will come back. It will leave a shock. It will leave an impact that is undeniable. But can we recover from it? Yes, I do believe they can recover from it. As this is what we have to tell clients or investors who are panicking. You anyway bargained for volatility. And the volatility is happening now. We should take advantage of it. Both ways. They must sell out at this point of time, and if possible, buy more of the equity funds or stocks that you like are fundamentally strong. You need to have a time horizon. That is more important. As long as you have a long enough time horizon, you are able to go through this. And the other point is, if as some people say, I left my money in an FD rather than go through this volatility, then be happy with that 6% gross rate and a 4.5% net of tax rate. Be happy with that 4.5%. Then you won't have any tension. But are you willing to scale down your goals such that you can achieve them within your 4.5% rate of return? That is a question to ask. And if you want a higher rate of return, you should be willing to go through this volatility. This is the price you have to pay to get that higher rate of return. It is the price you have to pay to chase a higher goal. Or a compromise. One of the two. Good to it. Yeah. Anything else you find interesting in...
Yes, actually. So, we have a very interesting article in the ET Well, which talks about the great NRI rebalance, right? So, it's geopolitical tensions which are pushing NRIs to rethink their portfolios. So, and that's not the only thing. And a lot of people are also questioning whether they should actually move back to India. And most people make certain mistakes, right? If you want to move the portfolio to India or at least a portion of your portfolio to India, not a lot of people have clarity on what to be. They end up bringing all their money back at once. They don't think about their asset allocations. They ignore tax structures, foreign asset reporting issues. So these are all things to keep in mind. And the only time it actually makes sense to move all of your wealth back to India is if you're relocating immediately. But if you're looking at relocating or retiring sometime in the future, then I think it's better to keep your wealth abroad, or at least move some portion of it to India.
So I would guess that we should avoid knee-jerk reactions.
Right.
Don't get into this all or none business. Yeah. Spread your bets. Diversify. So even if you're relocating to another country, then yes, the country that you're relocating to should always have the maximum of your wealth, but you can still leave and you should have some amount of your wealth in other economies, in other countries. Just like we tell Indians, resident Indians, to invest outside India. Those returning to India from other countries should still have some of their wealth in those other countries as long as they're stable economies. Okay, if you're in a banana republic, well, I wouldn't care too much about investing there. But then you should be geographically very diversified. And the principle, I guess, to maintain is wherever you are in the world, wherever you're incurring your daily expenses, that is where you need to have a substantial amount of just to be on the safer side. And the rest of it, you're free to diversify anywhere. So I think one should forget diversify. Keep a plan B always. Wherever you are, have a plan B.
Yeah.
So on that note, I think we'll say goodbye to this edition of BT. Have a great weekend, and let's see what Monday has in store for us.
Thank you so much. Have a great weekend.